My name is Bob Bush. I'm a Senior Vice President at Calamos Investments. I'm Director of Closed-End Fund Product. Sure, as we've talked about, advisors should never change the allocation of their client's portfolio based on closed-end funds. What they should do, though, is use closed-end funds as a supplement to their various types of asset allocation, however they have them positioned. And the nice thing about the closed-end fund space is it lends itself to a multitude of asset management strategies and exposure to sectors, regions, and so on. So you can invest anything from emerging markets to municipal bonds to convertibles to high yield and anything in between. So there are a number of vehicles. And so what we suggest is that they think in terms of investing in closed-end funds to supplement these specific sectors or regions that they choose to have their clients invested in. And what it does is it gives you a little bit, maybe more, a little bit risk associated with it because they are using leverage, but they will give you that income. And as we talked about in a low interest rate environment, many funds are able to borrow at relatively low rates, sometimes just a little bit of spread over LIBOR, and reinvest them into markets that have performed very well this year, whether it be the convertibles, high yield, equity markets. And so these funds are able to return that spread in addition to what they'd be earning on their unlevered portions of the portfolio. And from a net asset value perspective, they've been able to put out some very, very handsome returns, not only on an absolute basis, but certainly on a relative basis. The closed-end fund space is trading very, very well now. It's come out of what I would call a very difficult period of time over the course of probably the last year or so, where they were trading at discounts that were fairly prolific across all sectors, levels that we really hadn't seen since the financial crisis of '08. But because of a rallying equity, convertible, fixed income markets, coupled with low borrowing costs, these funds have had propelled great returns from an NAV perspective, and that's obviously propelled the stock prices as well. And so those discounts have narrowed considerably, basically across all sectors, and that shows for a very, very healthy closed-end fund environment. Yeah, convertibles are a great strategy in that it's somewhat, we say you're paid to wait. So in a rising interest rate environment, it helps in a number of ways. Convertibles typically are low duration instruments, which means that they don't have the same type of interest rate exposure that other more investment grade, perhaps taxable or municipal bonds have. So they're not as impacted by rising rates as much. But the other flip side is because they have that equity exposure, they should also do well in a rising interest rate environment, because again, think in terms of a rising interest rate environment, generally that's good for businesses in that they're obviously having better returns with respect to their own equity and their own investments, and so that buoys the interest rate environment. So the stocks, the equity portion of that vehicle should improve as well. So you get the equity upside in the convertible while managing the downside risk of the fixed income environment because you have that low duration on the bond portion. So it's actually a very good investment to consider during a time where you may have a rising rate environment. Yeah, sure. I think this space does ebb and flow with respect to how it performs, and it's not only a factor of what the general market's doing, but it's also what the investors' considerations are. And many times it's driven by fear of rising rates. I think over the course of the last year or so are what brought it to pretty high discounts. But as we pointed out, really the fear of rates didn't impact the space as much as people thought it would, because these funds tend to borrow at floating rates. Those floating rates really didn't increase that much, and so these levered portfolios were able to enhance their returns because those rates maintained low. And so I think now it's in a position where I think it will think in terms of going out, and there is more investor confidence in it, given that they performed well and those discounts have narrowed, and it'll allow the space to think in terms of sort of different and new ways to look at new funds to produce. Other ways that you can utilize the benefits and the power of the closed-end fund sleeve to sort of different ways of thinking. The one thing about the closed-end fund space is it's always been, it's focused on ingenuity. And these products are engineered because you have a lot of people thinking in terms of how we can address what the market is looking for at this particular period of time. So the really, necessity is the mother of invention in closed-end fund space, and many of these products will come to pass because they'll assess what investors need and put it out. And when the market is trading well, receptivity of that ingenuity, I think is heightened.